Keeps Institute, and this video is made by Joseph. My name is Joseph, and I'm glad to be making this video once again for all of you. Yes, in today's video, we're still on the demand and supply strategy. And in today's video, what I'm going to be talking about is that we're talking about how to trade demand and supply. Okay, so that you just want to trade demand and supply just like that, or how do you trade it? Don't forget when I told you that in the strategy, you must have an entry point, you must have an exit point. Not just that. You don't just want to look at one confluence and then trade that market without just one confluence. No, you want to be looking at two or more confluence. At least if they are two, to be okay. And then you'll be sure that okay, this trade is actually very, very bad. Okay. So having said that, if you know you are new to my YouTube channel, kindly subscribe. Like, click on the description so you can get notified each time I upload new content. And if you find this video very informative, please kindly feel free to like and share this video to your loved ones. With that being said, what I'll be talking about now is I'm talking about demand and supply. Okay, demand and supply, how you can create demand and supply. Okay, now in this video, like I was saying that you don't just trade by one confluence. Ordinarily, a demand zone and a supply zone are key and major areas where you should be looking at either buying from the demand zone and selling from supply zone. That is just one. But are you just going to use that and say you want to trade? No. You must look at some other things that's going to enable you on how to what to trade effectively. And one of the ways I trade my demand and supply zone is the use of the use of VAC, that is volume spread analysis. That is, I want to add volume to this my chart here. I'll be looking for volume. So I'll look for volume to add. I want to add volume to my chart. Okay. So this volume, I'm adding it here. So now these are volumes. Now, all these green things you are seeing that they are all called volumes. So how do you make use of volume in analyzing your charts? Well, I wouldn't want to just go into that aspect for now, but this is what I'll be doing. I would want to what else? I want to mention three kinds of volumes. Now there are three types of volume that I personally, based on my own personal strategy. Number one, the high volume. Number two, the mid volume. And number three, the low volume. You understand? Number one, the high volume. Number two, the mid volume. And number three, the low volume. Get that? Please don't mistake that. So when you are like, for instance, these are high volumes. These are high volumes. This is a high volume. This is a high volume. You can see them. These are high volume. These are high volume. These are high volume. You don't have to stress your eyes because you will just see them. They will stand out. They will stand out among their peers. All these are high volume. All these are high volume. So these are all high volumes. Why this something like this over here is a medium volume. These are medium volume. These are medium volume. You just need to. These are medium volume, and this is a low volume. Very, very low. Now these are low volume. This is a low volume. Understand? This is a low volume. So those are volumes. So we have low, high, and low, high, and medium volume. Now, how do you trade using the now there's something we call volume spread analysis, that is VSA. Now, what you're looking at for is that you're looking at the volume when you compare to the spread of the candlestick. Now, let's assume this is a candlestick. Let's assume this is a candlestick. Pardon my drawing. Let's assume this is candlestick. Okay. Now, what we mean by spread is the body. This from here to here. So the body is the what we call the spread. So that's what we call volume spread analysis. That was named by VSA. You understand? V for volume. This is the volume over here. Spread. That is the body of the candle. Like this. This is spread from here all through to here. This is spread and analysis. So you analyze the volume and in relation with the spread. That's what you call VSA. You understand? So that's it. So when we look at the volume, we're looking at in relation, we're looking at it in relation to the spread. Okay. Now, why you can there are other strategies. I mean, the other things that you can use. There are indicators that you can use aside from volume. Volume. You can use some other. You can use another. Um, um, you can use some other indicators. Do you understand? But like some other oscillating indicators. But the reason I prefer using volume is the fact that you see the market makers, the dealers, they can manipulate all these things you are seeing over here. They can manipulate them, all these charts, they can manipulate them. But the truth is that they can never, I repeat, they can never manipulate volume. Volume will always appear the way it is. Volume will always appear the way it is. They can never, ever manipulate the volume. So when you're making use of volume, you're making use of a very, very strong indicator to trade with, not just anyhow indicator, because they can't manipulate the volume. The volume will always show the intention of the market makers or of what they are doing. Okay. Now, what we'll be looking at here, the major strategy I built around this VSAs, that is volume divergence. That is when there's a divergence between the volume and the spread of the market. That is what the volume is saying. The market is not saying the same thing. That is the candlestick of that particular volume is not saying the same thing. Then that means you should be expecting a reversal. That's what the divergence means, is that when the indicator and the market chart, they are saying entirely different things. You understand? So that's what you mean by volume. I'm not even by divergence. So we're looking at divergence with volume, and a different way that we can look at divergence. So I'll be teaching you number one way, and I'll be talking about the subsequent ways in my other videos. That's why you need to like and subscribe to this channel. Then click on the notification bell so you can get notified each time I upload new content. You understand? Because this is not just the end of volume and of demand and supply. I will still be analyzing more, speaking more about volume to you. Okay. Now, that being said, let us now. I've seen a supply zone which I have seen here. Supply zone here. This over here. So this is supply zone. So you can see from here if I want market it. Market moved down, came back to test, then began to give us a lower low, isn't it? A lower low. And the market gave us this, then start going, moving up, then market gets this place. So at this place, you were looking at what? At selling, because market is as what? As a what? At a supply level. But do you just want to sell immediately? No. You want to look at some other indicators to tell you that this is sell. Now, this is where volume analysis comes in. I want you to look at something about divergence. Now look at this. Look at it. That means this candle over here, this volume over here, this long volume. Let me make it so. Okay, let me make use of this. Okay, let me annotate it so you can see. Now, this long, this is a high volume, right? But very, very high, extremely high volume, right? This. When you trace this volume, when you trace it to the candle stick, if I'm correct, you know, but let's make use of the so you can see it. Okay, okay, yes. This is a candle. I've seen it. Now this candle over here, this is the volume here. Now, my question to you here is that when you look, I said we are using VSA, that is volume spread analysis. That is, when I explained that the spread simply means the body of the candle stick, the body, not the wick. We're not considering the wick, but just the body. Now, when you consider the body of this candlestick, and then I consider this volume, does it correlate? Does it? No, it does not, because the body is just like about a small body. I mean, the spread, this body over here, this body of this candlestick is just like a spread. I mean, the spread is just like about a small spread, not that big. But when you look at it in relation with the what? With the volume that is being imputed, that is being recorded on his behalf, you will see how huge the volume is. The volume is so high. And then, but the body of the candle is not, I mean, the spread of the body is not so as high as the volume. That means there's a divergence. That means the volume is speaking something else. The volume is saying something else, and the candlestick is saying something else. That means there's something not right about this thing. So there's a divergence between the volume and what and the spread. That is the body. Now, and once you see that divergence, it means that what the market is going to what is going to reverse. Can you see that after immediately this this market ends, what happened? The market was moves down. Can you see how volume works now? Now let us now use it in relation to this. This is a supply level, right? Now now the market is present at this place. Now look at what forms here. Then there's a huge market wick over here that forms. Then look at what happened here. Now let us take our indicators, this, so we can know the spread of the candle. This spread FM. Now we are there. Yes. So this is the, yes. Okay, we've seen it now. We've seen the volume, then we've seen the candlestick. Now let us highlight it. Now this candle, pay attention. This candle over here, and this is the volume over here. Now, when you analyze the spread of this with the volume, does it correlate? Look at the spread over here. This is just the spread. Now look at the candle. Look at the volume rather. Can you see that this is also an high volume? Does this correlate? Now imagine this. Look at this. The preceding candlestick. Look at how huge the spread is. How huge the body is the spread, right? Now look at the volume responsible. This is the volume. Can you see how huge it is? Now, do you not want to compare? Let me clear it so you can see it clearly. Do you want to compare the body of this candle with this? No, it is not even up to quarter. One quarter of this candle. The body of this candle that is from here to here is not even up to one quarter of the body of this candle from here to here. It's not up to one quarter. But when you look at their volume, you can see that, look at just Look at this gap. The gap between the two volume is very minute. So that means that just the the this volume, the body of this candle, this the body of this candle that is spread, the body is saying different thing from that of which the volume is saying different thing entirely. They do not correlate, they do not match up, they do not add up. Why you know what I'm saying? So no adding up. There's no correlation with them. So the divergence because the volume is telling us that the market has a high volume, but the spread of the candlestick is telling us that it's a low spread. Wow. But ordinarily, the rules of volume and volume analysis stated that if the volume is high, the spread also must be high. If the volume is low, then the spread also must be low. But now, in this place, the volume is what? Is high, but the spread is low. Now, there's a divergence in volume. They are speaking different things. So, which helps us to signify what? A reversal is the self, the self, the self side. And if you are comfortable with chart formation, I mean, candlestick formation, this is a what? This is a pin bar in the candle, which signifies the sell also. You understand? So, this like three correlation. The first one is that what market is at presently at the supply zone, a very strong one at that. One. Number two, there's a what? There's a volume spread divergence. That's number three. Number two. Number three is that there's a what? There's a pin bar. And in the candle, if you want to make use of the candlestick formation to analyze also three. So three confirmations has tell you that this is going for a sell. Then what you want to sell after the close of at around this place or this place, then you want to take profit at around this level. But if you want to have a take profit one, you can say take profit one, take profit two, take profit three, take profit four, and then you're out of the market. So that's how to trade the supply and demand using the volume spread analysis. Okay, so let us look at an example of what of a demand market, of a market that is in its demand zone. This is an example of a market that is in supply zone. Let's look at first for the demand zone. Yes, this is XRP on the 1 hour time frame. XRP USD. So plotting our supply, our demand zone. Yes. Let me put it out here. It's so blurry. You have to stretch yourself before you can get them. If you don't, if they're not visible enough, that means it is not. You always see them. You always see them. So this was a plus from yesterday. You understand? You want to plot. Okay. So this is a demand zone. This is there in the demand zone, and market moves up with a high push, with a high push. It's kind of that all these things I'm doing, I did not pre-record it or I did not make the analysis first. I just make the video, go to the chat, look for examples, and then I give it to you guys the way I say it. So it's not as if I have studied the market before. No. So I just come and then do it for you. Just make the videos, then I make analysis right the way I'm looking at the chart. I don't make any other formal preparations. No formal preparations in this at all. Not, then everything you see me doing here is just in its raw form. I do not edit videos. I don't do that. I just give it to you the way I say that you know that it is in its raw form, in its raw content. It is not as if I have to first look out for a market price that suits what I'm doing. No. Once I see them, I just give it to you the way I see. So market moves up here. Look at this. The way market moves, giving us a high, then market coming back down to this level, to this demand level, demand zone, you can see. Then market starts what? Ordinarily, they are expecting to want to buy, but you want to buy immediately. No, what you want to do is that you want to wait for further confirmation, that is, you want to put in your volume, so you can make use of the volume spread analysis. You understand? Excuse me. So you can make use of the volume spread analysis to analyze the market and to know how the market is going to be. So now, looking at the divergence of volume, market is presently here, right? Now, this volume, this spread, and this volume, did they correlate? No. They are somewhere. Now, this spread, that is the body, that's what we call spread. This spread, the body, and this volume, they correlate? No. The the body, the spread of this and this, they correlate? No. The body and this, they correlate? The answer is no. These are clues to tell you that the market is about to reverse, because when you begin to see a divergence, that is, it is, I'll come again. Volume, volume, spread. This spread is also means body of the week. Okay, it means the body of the week. Volume, these are the volumes. These are the volumes on underneath, green things. These are the volume. The spread signifies the body of the candlestick. Let's assume this is a candlestick. I cannot stress this enough. The spread is what? Is the body of the candlestick. Okay, that's the spread. Not considering the wick. The wick is not the spread. You don't add the wick. The spread is what? Is the body. So that is from here to here to here is the spread. Have that and bear that in mind. Okay, it's going to do you good. And when I'm for looking at volume, volume and spread divergence, is that number one law of volume is this, that high volume equals to high spread, and high spread equals to high volume. Low spread equals to low volume, and low volume equals to low spread. That is, anytime you see a low spread or a low volume, let me say, anytime you see a low volume, you are expected to the next. If you look at the candlestick that forms that volume, it must be a low spread. The body must be low. When you see an high volume, then when you look at the candlestick that forms that volume, it must also have a body of what? A big volume. A big spread. Are you get what I'm saying? So, but when these two things are saying different things entirely, then that there's a divergence between volume and spread. In that kind of case, when there's a divergence, that is, when the volume is saying different thing and the spread is saying another thing, then it means that the market is about to reverse. And when the market occurs in a in a place of interest, like in a demand zone, it is a good confluence, or is a great confluence going to show that this market is going for what? For a buy. And as you can see, market is on the demand zone, and then all these pin to the lower side. For those of you that did price action, support and resistance, if you have not watched my support and resistance trading strategy, go and watch the video now. So for those of you that watched it, can you see them? So all these pins to the lower side are proves that the market is going to reverse, considering putting into consideration the volume too. That means you have number one, market is at the demand zone. Number two, the volume and spread is divergence. Number three, the wicks lower to the lower side. It shows that what market is about to reverse. So three confirmations, and then you want to buy, and then you want to set your stop loss below the low. Okay, and then you take profit. You want to set it at around this place. Then market moves up, and then each was take profit, and that's how you win indeed. Okay, so that's that about volume and spread analysis, and this volume divergence. Though there are other ways that you can trade the market using volume divergence. Okay, the other ways. This is just one out of volume divergence. The other divergence also that you can look at. That's that way that you can also trade volume. and can trade using volume, but those other ways they are not as effective as this. You understand? But I will be uploading the video subsequently. Okay, I'll be putting them on my channel. But for now, these are the things that I personally use. This is how I trade volume, demand and supply using volume square analysis. This is how I trade using, you understand? These are trades. So I've taught you what I use. And the other things I use on demand and supply, I'll be uploading the content very soon. After I am done with the whole, um, I've covered price action. Now I have covered demand and supply. Then once the next point of tutorial I'm going to do is that I'll be covering BTMN, be the market maker structure that was popularized by Steve Morrow. So once I'm done with that, then I'll be able to come back to other aspects of this volume and this demand and supply. Then I'm going to upload those videos under this playlist. Understand? So that you can watch other. Ordinarily, personally, I use divergence of volume and spread to trade demand and supply. But there are other ways that you can trade even without using divergence of volume and spread. There's, but I want to teach you that also. But all those kind of this thing, they are not as common as these. These are always very, very common, and these are very, very effective. Sometimes when we are trading using the VSA method to analyze to trade demand and supply, sometimes the volume will be equal with the spread. Then what do? Then the next thing is that you look at the next volume before it, before the present volume. The next volume, you want to look at it that okay, what happens to the next volume? Because sometimes markets will want to reverse, but the indication will have shown from the previous volume. So these are one of the things I want to teaching you on volume spread divergence also, not just, you understand. Sometimes it is not the actual volume, it is not the actual present price action that's going to give you the divergence. Sometimes it's going to be the previous volumes, you understand. So you have to look at them. So what are they saying? Okay, are they saying reversal? Then you want to reverse. Based on the fact that once the price is in demand for a supply zone. So that being said, guys, if you know you've enjoyed this training tutorial on demand and supply, please kindly make sure you like and you subscribe to this YouTube channel. Let me share this video if you find it very informative and very, very educative. Uh, until I come your way, stick with my channel. There's more content to come. The next is more content to some talking about PCM in the next series. Thank you very much, and God bless you. Have a great trading week ahead of you.